Welcome to the Deep Dive. You're here because you need the crucial market intelligence, the signals, the surprises, the core data, all of it, stripped down and delivered for the start of the first real trading week of 2026. This isn't just a recap, this is your fast track into what matters right now.
Exactly. Our mission today is a rapid but really comprehensive distillation. We're looking past the holiday haze and straight into the foundational themes that are defining the markets this morning, Monday, January 5th.
And the central tension, the gravity well that everything seems to be orbiting, is this tricky mix.
It is.
You've got these two major structural forces. Persistent mid to high interest rates, and they're fighting against this massive amount of short-term seasonal liquidity noise.
And that long-term anchor, the U.S. 10-year Treasury, is just holding stubbornly around 4.18%.
That 4.18% figure feels like the number that matters most. Yeah.
You could argue it's the most important number in the financial universe right now. Why? Because the cost of capital is sticky. That sustained high rate, it just keeps applying constant valuation pressure.
Particularly on tech.
Particularly on those high-growth tech sectors, yeah. They rely on future earnings being discounted back to today. Every dollar earned in 2028 is worth less today than it was a year ago. That dictates everything.
Okay, let's unpack this. I want to start with the plumbing, the mechanical workings underneath the market that are creating so much of this noise. We're talking about massive record-setting liquidity events from the New York Fed right around year-end, which, frankly, sound completely contradictory.
They do sound counterintuitive.
Yeah.
But if we connect this to the bigger picture, the context confirms this is, it's generally understood as a massive seasonal balance sheet adjustment. Some people call it window dressing by the banks.
Let's slow down there. We need to explain this plumbing because the numbers are huge.
Yeah.
Tell us about the two key facilities that saw this action on December 31st.
Absolutely. So we're talking about the two major repo facilities. First, you've got the New York Fed's standing repo facility, the SRF.
And that's where banks borrow cash, using treasuries as collateral.
Exactly. It's where they go for overnight cash. And on December 31st, the SRF set a record. $74.6 billion was borrowed. Banks were scrambling for cash.
$74.6 billion borrowed. Got it. Now, tell us about the other side, the overnight reverse repo, the on-end RRP.
So simultaneously, on the very same day, funds were being parked at the on-end RRP facility. We're talking about $106 billion.
And the RRP is where the Fed pays institutions to basically drain cash out of the system for a bit.
That's right, mostly money market funds.
Wait, I have to be the voice of skepticism here for the listener. On the very same day, institutions borrowed $74 billion for overnight cash, and they parked over $100 billion with the Fed. Why would you need to borrow cash so desperately while you're also sitting on a huge surplus?
And that's the core tension. And it's why understanding the plumbing is so key. If you were looking purely at supply and demand, it looks like a total contradiction.
Right.
But institutions use these facilities for very different reasons, especially at year-end. The borrowing, the SRF part, that often relates to banks needing to shore up their own balance sheets for regulatory reporting. They need to show certain liquidity levels right as the calendar flips.
So it's a technical requirement.
Pretty much. And the money market funds, the ones using the RRP, they're often just parking huge amounts of capital that they either can't or won't deploy into the private market, maybe low risk appetite or lack of good collateral.
So the massive volume, that record $74.6 billion, is more about regulatory pressure and technical housekeeping than, say, genuine market stress.
Precisely. It's a seasonal passive adjustment, part of the required financial architecture. But, and this is the insight, the sheer volume of it ensures that short-term liquidity stays a highly monitored topic. It's loud noise, and loud noise breeds volatility, even if the underlying stress isn't immediate.
And all that seasonal noise is happening while the real drama, the internal Fed disagreement over rate cut timing, just keeps playing out.
Which brings us to the strategic question for the next few days. What signs are investors actually looking for? The market has three key signposts right now.
Okay.
First, the upcoming economic data, the ISM manufacturing and services data, and of course the big one, non-farm payrolls. Second, official statements from Fed officials. And third, we just keep watching that SRF and RRP behavior. That confluence will dictate the short-term direction.
Looking at the broader macro picture, it seems like the economy is sending all sorts of mixed signals. It gives the Fed plenty of reasons to disagree.
Oh, absolutely. On inflation, core inflation is sticky. It's eased from its highs, sure, but it's not retreating to the Fed's target as quickly as they'd like.
And the labor market is still strong.
It's stubbornly resilient. We haven't seen a significant collapse in employment, which is good for workers, but it removes any urgency for the Fed to start aggressively cutting rates. Growth is still constrained, mainly by supply-side uncertainty, but there's no clear signal of a sharp softening just yet.
And before we leave the macro foundation, let's touch on the dollar. A high-rate environment like this usually gives it a huge tailwind.
It does. The U.S. dollar index, the DXY, is currently around 98.2 to 98.5. The data points to some short-term strengthening, climbing back toward multi-week highs as of today, January 5th.
And a stronger dollar means tighter financial conditions globally.
Exactly. It makes USD-denominated debt more expensive for international borrowers. It's just another pressure point in the system.
Okay, let's pivot now from the technical plumbing to where the money is actually flowing. Given that 4.18% gravity well is squeezing valuations, let's see which pockets of the market are still managing to defy it.
The main thing we're seeing is that funds are splitting and volume is thin, which just amplifies volatility. Capital is dividing between the perennial winner AI and technology growth stocks and the ultimate defensive play, safe havens, specifically precious metals.
Let's start with AI. That narrative just will not die. It seems like the market views the biggest AI players as these cash flow machines that are just immune to that 4.18% gravity. What are the indicators looking like?
Well, look at NVIDIA. It's sampled near $188 to $189. AI infrastructure is still the core, undeniable catalyst. The market isn't buying a story, it's buying the infrastructure that powers the future.
The picks and shovels.
NVIDIA is seen as the pick and shovel provider for that future, absolutely.
But at 188, how much of this is already baked in? I mean, what specific data point would make you start to question this relentless bullish trend?
That's the right skeptical approach. While the growth is real, the valuations are extremely high. The inflection point likely won't be NVIDIA's current revenue, but rather the upcoming CapEx reports from the major cloud providers, Alphabet, Amazon, Microsoft.
So what they're planning to spend.
Exactly. If those companies signal a big slowdown in their AI infrastructure investment or a major shift in chip suppliers, that is what would trigger a repricing in NVIDIA, not some small miss on quarterly earnings.
And the broad indices just reflect this concentration.
Totally. ETFs like VOO and QQQM are so heavily weighted toward these same players.
Right.
The Vanguard S&P 500 ETF, VOO, is near 628 to 629. The Invesco Nasdaq Q100 QQQM is between 252 and 256. They're both highly driven by the performance of those AI and semiconductor components.
What about the other big tech players like Meta and Alphabet? Is it all AI hype for them, or is there another driver?
Well, AI investment is crucial. Meta's trading around 650 plus, and Alphabet's in the 310 to 320 range. But their bread and butter is still advertising sentiment.
The health of the digital ad market.
Right. As long as the economy suggests corporations are still willing to spend heavily to reach consumers, these giants have a fundamental runway that's separate from the more speculative AI valuations smaller players are dealing with.
Okay, shifting gears completely. Crypto. Bitcoin is holding around a price that would have sounded like science fiction just a couple of years ago. At $92,000, it feels almost divorced from this whole high-rate environment.
It is showing surprising resilience. Bitcoin, BTC, is consolidating around that $92,000 to $93,000 range. Ethereum ETH is holding around $3,100.
And why is it holding up so well?
The two biggest reasons, I think, despite that 4.18% risk-free rate, are first, the sustained belief in institutional adoption after the ETF approvals. That provides a constant floor of demand. And second, the scarcity narrative. It just separates it from traditional rate-sensitive assets.
So what's the mood like among crypto investors at this altitude? Are people nervous?
The Crypto Fear and Greed Index shows a really crucial change. It's pulled back from extreme fear, and now it's sitting firmly in the neutral to caution range. We're talking 30 to 42.
So less panic.
Much less.
Yeah.
The near-term focus for serious traders is all on institutional behavior now. ETF capital flows, options expiry, and whether large holders are rebalancing after year-end.
Okay, now for the other side of that capital split, the traditional safe haven. The source material highlights a specific geopolitical event that triggered a spike in gold demand.
Yeah, and this is where we see traditional risk hedging really shine. We saw a very specific event U.S. action related to Venezuela, including the capture of Maduro, that instantly triggered safe haven buying.
So what does an event like that regime instability, a leader being captured, do to the gold market?
It causes spot gold to rebound, and strongly. It's trading near $43.70 to $43.80 per ounce. Silver is also high and volatile. This specific kind of geopolitical risk, the sudden kinetic failure of a sovereign government, is what gold has always excelled at hedging.
That's a crucial distinction. We always hear Bitcoin described as digital gold, but this event suggests that when major geopolitical risk happens, institutions still prefer the physical asset. Why is that?
It really comes down to counterparty and seizure risk. Gold has thousands of years of history as a store of value. Its custody is geographically decentralized. In a sudden, chaotic geopolitical scenario like a regime change or a war, traditional finance sees gold as a physical asset that doesn't rely on internet access or the electrical grid or any specific regulatory framework.
And the data supports this.
It does. The BTC to gold ratio dropped significantly compared to mid-year. That clearly indicates funds are rotating toward this traditional hard asset hedge when they face this kind of political instability. It shows gold still holds the crown for hedging sudden geopolitical chaos.
That's a powerful insight. The difference between hedging a systemic monetary risk, where BTC plays, versus pure political kinetic risk, where gold dominates. All right, let's dive into the area of highest speculation, the pre-stocks market.
We have to talk about the pre-stocks secondary market for these major AI entities. This is the ultimate high-risk, high-reward territory.
Explain quickly for the listener, what exactly is a pre-stock and why is this market so volatile?
So a pre-stock is just secondary market trading of private company shares. Shares held by early employees or investors sold through private platforms before an IPO. It's high risk because there's no public market regulation and information disclosure is minimal.
And this market is reflecting the AI hype even more intensely than NVIDIA. What are those private valuations telling us?
The data shows extreme activity, but critically, prices vary a lot between platforms. Anthropic pre-stocks are around $315 to $325. OpenAI pre-stocks are trading much higher, somewhere between $1030 and $1140.
Wow.
We also see XAI pre-stocks sampled around $95 to $100. The key risk here is the price variance itself. There's no centralized exchange, so the price you see on one platform might be wildly different from another.
High prices, high volatility, platform-specific risk. Meanwhile, what's the official measure of broad market fear? The VIX doing?
The VIX is actually sitting in a low volatility environment, around 14 to 15. The recent close was 14.95. But, and this is important, the sources clearly state that upward risk still exists. We're in a market with thin New Year volume.
So a shock could move it quickly.
Easily.
Yeah.
Geopolitical news like Venezuela or an unexpected data shock from the upcoming ISM or non-farm release could push the VIX up very fast. The calm is fragile.
Okay, so we have seasonal liquidity noise, sticky high rates, AI driving growth, and geopolitics driving defense. What's the recommended strategy for navigating all this?
The overall strategic recommendation really leans heavily toward defense first. Given the ongoing noise and the fact that rates are still stubbornly high, portfolio construction has to prioritize caution and diversification.
Let's break that down. Why are broad indices like VOO and QQQM so important right now?
They serve as your core defensive positions. They give you diversified exposure to the successful tech giants, the NVIDIAs, the Apples, the Microsofts, that have proven free cash flow and strong balance sheets. This protects you from the high risk of failure or valuation shocks that smaller, more speculative tech names face when the cost of capital is high.
You get the growth theme, but with a hedge against single stock disaster.
Exactly.
And for those who are determined to play the AI theme directly with the leaders.
Use a phased incremental buying strategy, dollar cost averaging or DCA. For leaders like NVIDIA, GOG, and Meta, you need patience. And crucially, consider using options for protection, like buying puts or just maintaining higher cash cushions. The growth is real, but the valuation compression risk from that 4.18% rate is just as real.
What about the safe haven side? Should everyone be piling into gold?
A small strategic allocation to physical gold is, I think, essential for hedging against these unpredictable geopolitical risks. We just saw proof of that. Gold is a crucial diversifier when traditional markets freeze up.
And silver?
Silver is far more volatile. Probably better suited only for shorter-term traders.
And finally, crypto. How should that be treated with Bitcoin at 92K?
Crypto should be treated with extreme caution right now. You are in the high zone. If you're trading short-term, use strict stop losses. If you're long-term, continue with DCA. But treat these entries as small position entries for speculative capital only.
And pre-stocks.
Pre-stocks should be tiny, purely speculative bets that you are fully prepared to lose entirely.
That was a comprehensive look, covering everything from the internal plumbing of the Fed's balance sheet all the way to geopolitical premiums in gold.
Before we close out this deep dive, there's one final provocative thought I want to leave you with that ties this all together. We've talked about the SRF and RRP, the massive seasonal liquidity chaos, and the persistent structural nature of the 10-year rate holding above 4%.
The ultimate tension.
Exactly. So the question for you to mull over this week is this. Are the upcoming non-farm payrolls and ISM data releases truly powerful enough to override the sticky structural reality of that 4.18% rate? Or are we going to find that the sheer volume of that short-term liquidity noise is simply masking a deeper mid-rate reality that is here to stay, regardless of one or two good economic reports?
Keep your eyes on those three signposts: the SR, FRRP data, the economic data, and the Fed talk. That is the perfect question to think about as you navigate this complex week. Thank you for joining us for this crucial deep dive into the 2026 market open.
My pleasure.
We'll catch you next time.